The headlines right now are screaming like a toddler who just dropped their ice cream in the sand. If you own a home, the media is currently trying to convince you that your financial life is effectively over. Why would they do that? Well, because President Trump just floated a ban on institutional investors, the big club, the Blackstones, the BlackRocks, the guys who wear fleece vests in July, banning them from buying single-family homes. And the pundits, they're calling it the housing death sentence. They want you to believe that if Wall Street is pushed out and dumps all of their properties onto the market, the value of your biggest asset, your fortress of solvency, is going to zero. Talking about your home. They want you to think that without the hedge funds artificially pumping up the price, your equity is just going to evaporate like a puddle in Phoenix. But here's the thing about the media. They are terrible at math. I've been running the numbers. I've looked at the mortgage-backed securities. I've read the boring PDF documents that they pretend don't exist. And the more I look at the actual data, the less this looks like what they're telling you, and the more it looks like something completely different. So in this video, I'm connecting the dots for you. I'm going to show you why Wall Street leaving the market is actually a Trojan horse for something no one is expecting, and how you can position yourself before this specific engineered 24-month window slams shut. Because the big club is rotating their money, and they didn't forget to tell you where the money is going, they just didn't care to. So for the last 5 years, the Crash Brothers on YouTube, you know the guys, the ones who have predicted 12 of the last 2 recessions, they've been saying the same thing. It's a bubble. Wait for the collapse. Cash is king. And if we wait long enough, I suppose someday they could be right, but here's the thing. To have a crash, you need one specific, non-negotiable condition. You need oversupply. You need more sellers than there are buyers. So do we have oversupply? No, we don't. We have a massive structural deficit. We are 4 to 5 million homes short of what the human population actually needs to sleep indoors. Because here's what the headlines miss. 8.1 million families are currently doubling up, sharing homes with non-relatives because they can't afford to live independently. 38% of them are millennials. And these aren't passive numbers. These are people with jobs, savings, and a trigger finger on a mortgage application the moment rates dip and credit opens up. We have way more humans than we have houses. That is simply biology meets concrete. So when the talking heads say, if Blackstone dumps their inventory, prices are gonna crash, I gotta ask, dump them into what? Into a market that is absolutely starving for rooftops? Even if Blackstone and Invitation Homes dumped every single family home they owned tomorrow morning at 9 a.m., that inventory would be absorbed by the millions of families currently trapped on the sidelines, living in their in-laws' basements, praying for sale sign on an introductory home. It's like throwing a single steak into a tank of piranhas and worrying the water level is gonna rise. The steak isn't gonna float, it's gonna get devoured. Yeah, but where are they gonna get the money to buy? Well, stay with me, I'll get to that. The main point here is the crash narrative is an ambush. It is designed to make you fearful, so you freeze. It keeps you paralyzed while the big club executes their exit strategy. And speaking of their exit strategy, that brings us to dot number 1. Why is this ban happening now? Is it because the government suddenly developed a conscience and decided to hug the middle class? No, it's happening because the big club got too greedy. A report recently from MetLife, the Snoopy blimp people, showed that institutions were on track to own 40% of all single-family rentals by 2030. That's the trend that spooked Congress. Essentially a corporate hostile takeover of the American neighborhood. Feudalism with the homeowners association. So Trump isn't crashing the market. He's stopping a trend that was becoming a political liability. I mean, what it always comes down to is this. If it doesn't make money or if it doesn't get votes, it doesn't get done. This ban on the institutions in the housing market will pull votes. So it's happening. But look at Wall Street's reaction. Are they crying? Are they panic selling? On January 7th, the day the president posted the ban, Blackstone's stock didn't just stumble. It tanked nearly 6% in a single trading session. Invitation Homes, the giant that owns 80,000 houses, dropped right along with them. Billions of dollars in market cap, gone before lunch. The market knows exactly what this ban means. It doesn't mean that they are legally forced to sell every house they own tomorrow. It means they are banned from buying more. It means the infinite money glitch where they outbid you with all cash offers, that glitch just got patched. But here's the part that proves this is engineered. Long before this announcement, the big clubs started pouring billions into something called build-to-rent neighborhoods, BTRs. These aren't houses for sale. They're communities of 50-plus single-family homes, purpose-built for permanent renters. No ownership, no equity building, just rent checks flowing upward. Blackstone alone spent $3.5 billion acquiring Tricon Residential in 2024 to lock in BTRs. They're not retreating from housing, they're pivoting. From competing with you to own the house next door to owning the entire neighborhood you'll rent from forever. They knew the political winds were changing. They knew Main Street hated them buying up the cul-de-sacs. So they built their own life raft. They are pivoting their billions away from buying your neighbor's house and into building entire subdivisions where private ownership is forbidden. They are moving from being your predatory competitor, trying to buy the house you want, to being the permanent landlord for the next generation. So for you, the homeowner or the wannabe homeowner, this is the green light signal. Your biggest competitor, the one with the limitless checkbook, just got handcuffed. They can't buy the inventory anymore, which leaves that inventory for who? Yeah, you. Exactly. But they can't just leave a vacuum. Someone has to buy those homes. And that brings us to dot number 2. Last month, Fannie Mae quietly changed the rules of the game. They didn't hold a press conference. They didn't buy a Super Bowl ad. They just tweaked the algorithm. They eliminated minimum FICO requirements for certain borrowers and started accepting alternative credit data. Instead of primarily looking at your credit score, they're now also looking at rent payments, utility bills, phone bills. This is the aha moment. Millions of people, hardworking people, who pay their rent on time, pay their electrical bill on time, but maybe, didn't have a traditional credit card history, or maybe they got bruised in 2008 and never trusted a bank again. They just got the green light to buy a home. Think about the timing. You got to appreciate the engineering here. It's almost beautiful in a terrifying way. At the exact moment the hedge funds are stopped from buying and are looking to rotate their capital elsewhere, Fannie Mae massively expands the buyer pool to include millions of new people. So that if the hedge funds do sell, they don't take a loss. That isn't a recipe for a crash, more likely a buying frenzy. They are manufacturing demand to match the supply coming from Wall Street. They're swapping one buyer, the hedge fund, for another buyer, the American family. But wait, there's a problem. Those families, they need more than just credit score concessions. They need money. They can't afford 7% interest rates on these prices. So how do we fix that? Well, enter dot number 3, the $200 billion anvil. On January 8th, the president dropped a nuclear financial weapon on the economy. He initiated a massive bond buying program. Now, we don't need to get into the boring weeds of yield curve control because that sounds like something you treat with ointment. Here's the simple version. The government decided to become the whale buyer of mortgage-backed securities. You see, when the government buys bonds, yields go down. When yields go down, mortgage rates come down. They pushed rates to the lowest level since September 2022, the biggest decline in 6 months. This wasn't an accident. This wasn't market forces. This was an engineered liquidity event. Here, connect the dots with me. Dot number 1, Wall Street is banned from buying, removing your biggest competitor. Dot number 2, credit rules are loosened, so millions of new buyers qualify to take their place. Dot number 3, interest rates are artificially smashed down so those new buyers can actually afford to buy the inventory. Does that sound like a crash setup to you? Or does that sound like the greatest redistribution of solvency we've seen in a decade? Now, if after you've connected the dots with me, you're now seeing that they've manipulated the system to save their own skins, Bingo! You are absolutely right. You aren't crazy. You are observant. You are awake. But here's the reality of the situation. You cannot change the wind. You can yell at the wind. You can talk trash about the wind. You can post angry comments about the wind on Facebook. But the wind doesn't care. Interest rates are being forced down. Inventory is being released. Credit is being loosened. But here's the thing everyone forgets. They aren't building. Builder confidence isn't just low, it's in the gutter. It's hovering at recession levels. Builders are terrified of the same headlines you are. So now do this math with me. We know that even if the Blackstones released every single home they own tomorrow, it wouldn't be enough, not nearly close enough to fill the 5 million home deficit. Not even close. And we know the builders are sitting on their hands, refusing to dig new foundations. So once that initial wave of Wall Street inventory gets absorbed by the hungry market, what happens when the for sale signs run out, but the buyers are still standing there with their new Fannie Mae loans in hand? What happens to the price of the only asset left standing, like your home? Your value doesn't crash, it launches. So the question isn't, will it crash? The question is, what are you doing with all of that power? You see, your house, it's like a battery. It holds all your financial energy. But when that battery is sitting in one jurisdiction, exposed, it creates a single point of failure. The smartest defense isn't to hoard that equity in a single pile, it's to disperse it. It's to spread your eggs into different baskets so you aren't a stationary target. Because keeping your name on a massive pile of equity under one roof makes you a sitting duck. Go grab that at inflationdefense.com. It breaks down the plumbing of how to turn that stagnant equity into a moving target. Because right now, there is a new ideology entering the room. It's a wolf in sheep's clothing. It is being sold to the public as a victory for the little guy, a way to finally tax the billionaires, to finally tax the rich. But that is the trap. Rich or poor, it is the trap. In fact, it's the trap of all traps. Because once they set the precedent that the government can tax unrealized gains, money you haven't even made yet, the billionaires aren't the only ones on the list. Your home equity is definitely next. And that is why I pulled this video out here for you to watch next. It breaks down the specific laws they are passing right now, starting in California and New York and coming to a state near you, that are designed to open the door to your front porch. You need to see exactly how this Trojan horse works and why the billionaire tax is actually a quiet move on your personal private property, billionaire or not. Watch this right now.